This LOS is explain the impairment of property, plant, and equipment and intangible assets. Impairment of assets. Accounting standards do not require that plant, property, and equipment be tested annually for impairment. Rather, at the end of each reporting period, generally a fiscal year, a company assesses whether there are indications of asset impairment. If there is no indication of impairment, the asset is not tested for impairment. If there is an indication of impairment, such as evidence of obsolescence, decline in demand for products, or technological advancements, the recoverable amount of the asset should be measured in order to test for impairment. For property, plant, and equipment, impairment losses are recognized when the asset's carrying amount is not recoverable. The carrying amount is more than the recoverable amount. The amount of the impairment loss will reduce the carrying amount of the asset on the balance sheet and will reduce net income on the income statement. Asset will go down, equity has to go down through net income, through the retained earnings. The impairment loss is a non-cash item and will not affect cash from operations. IFRS and US GAAP differ somewhat both in the guidelines for determining that impairment has occurred and in the measurement of an impairment loss. Under International Accounting Standard 36, which is IFRS, an impairment loss is measured as the excess of carrying amount over the recoverable amount of the asset. The recoverable amount of the asset is defined as the higher of its fair value less cost to sell and its value in use. Value in use is a discounted measure of expected future cash flows. So you see there's a two-part process there to measure for impairment loss. Number one, you have to figure out the higher of the fair value less its cost to sell and the value in use. You take the higher value and you compare it against the carrying value. And if the carrying value is higher than that recoverable amount, then you've got a loss, okay? And the asset is impaired. Under US GAAP, assessing recoverability is separate from measuring the impairment loss. An asset carrying amount is considered not recoverable when it exceeds the undiscounted expected future cash flows. So then you've determined that the asset is impaired. So how do you calculate the loss? If the asset's carrying amount is considered not recoverable, the impairment loss is measured as the difference between the asset's fair value and carrying amount. In contrast with depreciation and amortization charges, which serve to allocate the depreciable cost of a long-lived asset over its useful life, impairment charges reflect an unanticipated decline in the value of an asset. Both IFRS and US GAAP require companies to write down the carrying amount of impaired assets. Impairment reversals are permitted under IFRS, but not under US GAAP. So first, let us look at impairment of property, plant, and equipment. Accounting standards do not require that property, plant, and equipment be tested annually for impairment, rather at the end of each reporting period. We've mentioned that already. A company assesses whether there are indications of asset impairment. If there is an indication of impairment, such as obsolescence, decline in demand for products, or technological advancements, the recoverable amount of the asset should be measured in order to test for impairment. For property, plant, and equipment, impairment losses are recognized when the asset's carrying amount is not recoverable. The carrying amount is more than the recoverable amount. So we saw under IFRS and US GAAP how we do the calculations and calculate the loss, okay? The amount of the impairment loss will reduce the carrying amount of the asset on the balance sheet and will reduce net income on the income statement. The impairment loss is a non-cash item, will not affect cash flows. Impairment of assets. Now we'll look at impairment of intangible assets with a finite life. These assets are not tested annually for impairment. Instead, they are tested only when significant events suggest the need to test. Impairment of intangibles with indefinite lives. Intangible assets with indefinite lives are not amortized. Instead, they are carried on the balance sheet at historical cost, but are tested at least annually for impairment. Impairment exists when the carrying amount exceeds its fair value. So that's important to pick up on these small differences between impairment of intangible assets with a finite life and impairment of intangible assets with an indefinite life, okay? Moving on to impairment of long-lived assets held for sale. A long-lived, non-current asset is reclassified as held for sale rather than held for use when it ceases to be used and management's intent is to sell it. For instance, if a building ceases to be used and management's intent is to sell it, the building is reclassified from property, plant, and equipment to non-current assets held for sale. Reversals of impairments of long-lived assets. IFRS permit impairment losses to be reversed if the recoverable amount of an asset increases regardless of whether the asset is classified as held for use or held for sale. Note that IFRS permit the reversal of impairment losses only. IFRS do not permit the revaluation to the recoverable amount if the recoverable amount exceeds the previous carrying amount. And recall, under US GAAP, no reversals of impairments are allowed. So let's do a practice problem to check our understanding. A Canadian printing company which prepares its financial statements according to IFRS has experienced a decline in demand for its product. The following information relates to the company's printing equipment as of 31st December 2010. The carrying value of the equipment, net book value, is $500,000. The undiscounted expected future cash flow is $550,000. The present value of expected future cash flows is $450,000. The fair value is $480,000. The cost to sell is $50,000, and the value in use is $440,000. The impairment loss in Canadian dollars is closest to A, 0, B, 60,000, or C, 70,000. Okay, this is an excellent little question to test your knowledge on impairment under IFRS. So that's the important thing. You got to read carefully. This is according to IFRS. So when we go through the data, there's again sometimes some red herring information, some numbers that you don't need. And one of them is the undiscounted expected future cash flows. Recall, that's a number that we need if we're using US GAAP, okay? So that is out. Now, we always need the carrying value of the equipment, the net book value. That's what we're going to compare to the other numbers and see, determine the test whether the asset's impaired, okay? So remember, I said for IFRS, it's a two-step process. The first step is you have to calculate the fair value less cost to sell, and you need to compare that versus the value in use, okay? And then you choose the higher number, not the lower. So you can see here that the fair value less cost to sell is $430,000, and the value in use is $440,000, and you choose the higher. So that's step one. I'm choosing the higher, which is $440,000. Step two is to compare the higher of the fair value less cost to sell versus value use versus the carrying value of the equipment. And we can see here the carrying value of the equipment is $500,000, which is greater than our $440,000. So indeed, the asset is impaired. We're carrying it at a value higher than our calculation for our test for impairment. And you can see the difference. I don't even need my calculator. It's B, it's 60,000, okay? So if you would have chose the lower number, 430, by mistake, you would have chose C, which is 70,000, okay? And if you would have got confused and thought, oh, the undiscounted future cash flows is more than 500,000, so there's no impairment, you'd also be wrong. So remember, with IFRS, very important two-step process. Number one, calculate the fair value less cost to sell. Compare that to the value in use. Choose the higher value. Compare it to the carrying value. If it's lower, then the asset's impaired, and the charge, the impairment loss, is the difference between the carrying value. Okay? Very nice little question. As I've said, if you don't have a strong background in accounting, these impairment questions just take a little bit of practice to compare between IFRS and US GAAP. So let's do another one here. Here's a practice question, and now it's the company prepares its financial statements in accordance with US GAAP, generally accepted accounting principles. It is expected to be the sole supplier for a statewide school milk program and had production facilities valued at $28.4 million. Recently, several other companies were also granted milk supply contracts throughout the state, and the company now estimates that it will only be able to generate cash flows of $3 million per year for the next 7 years with its facilities. The firm has a cost of capital of 10%. The impairment loss in millions on the production facilities will most likely be reported in the company's financial statements as A, $13.8 reduction in operating cash flows, B, 13.8 impairment loss on the income statement, or C, 7.4 reduction in the balance sheet carrying amount. Okay, this is a little bit of a tricky question. I would say maybe almost unfair in its wording, but that's why it's a good one to practice, okay? So first of all, we're looking at US GAAP, and we're checking to see whether the asset is impaired. So I've copied and pasted from the previous slide the rule for US GAAP. Assessing recoverability is separate from measuring the impairment loss, okay? So is the asset impaired? An asset's carrying amount is considered not recoverable when it exceeds the undiscounted expected future cash flows. So they've given us here the undiscounted expected future cash flows. It's $3 million per year for 7 years. So I don't even need my calculator. 7 times 3 equals 21 million, okay? Now, as I said, they have a production facilities, it says valued at 28.4 million. And that's the sort of the wording that I take issue with, because it would be more clear if it said it had a net book value of 28.4 million, and I'll show you why in just a minute, okay? So we can clearly see, though, that the undiscounted expected future cash flows is less than the carrying value, or if this said the net book value or the carrying value, 28.4. So yes, indeed, the asset is impaired. So that's step number one. Step number two, we need to calculate the amount. And this is why I said I take a little bit issue, because they say value. When under US GAAP, if the asset's carrying amount is considered not recoverable, the impairment loss is measured as the difference between the asset's fair value and the carrying amount. So they haven't given you the fair value here. Recall the definition for fair value is the amount that two parties would exchange in a arm's length transaction, okay? But it hasn't given you that, and it's given you valued at 28.4 million. So if you made a little bit of a mistake and said, well, that's the fair value, because it has the word value there, 28.4 minus 21 gives me my 7.4. Aha, I'm going to choose C. No, I'm going to be wrong according to the answer for this calculation, because the fair value in this case is the present value of the future benefits. So you have to bring up your calculator, and you need to check your IY is 1. And you can see that the N is 7 years, and the interest rate is 10%, so 10 IY, and the payment is $3 million a year, and the future value will be 0. And so I'm going to compute my present value. I'm going to get 14.6, okay? So if I just, if I compare that to my 28.4, which is my carrying value, okay, we have a difference of 13.79, okay? So the impairment, the calculation for the impairment is 13.79, and that's not a reduction in operating cash flows. You should know that that one was wrong automatically, okay? And also, yes, there is a reduction in the balance sheet carrying amount, but the impairment loss is on the income statement, okay? So B was correct. So the issue with that one is just a little bit of the wording. It's US GAAP. Step one, you have to look at the undiscounted cash flows to determine whether it's impaired. Step two, the impairment loss is measured as the difference between the asset's fair value and the carrying amount. But in this case, the fair value, there's no arm's length transaction information. We're still going to calculate again the present value of the benefits to come up with the fair value. And that's the little trick there. Nice little kind of tricky, difficult question with the wordings. 2 practice questions to finish this LOS. Assume US GAAP applies unless otherwise noted. A company has equipment with an original cost of $850,000, accumulated depreciation of $300,000, and 5 years of estimated remaining useful life. Due to a change in market conditions, the company now estimates that the equipment will only generate cash flows of $80,000 per year over its remaining useful life. The company's incremental borrowing rate is 8%. Which of the following statements concerning impairment and future return on assets, ROA, is most accurate? The asset is A, impaired and future ROA increases, B, impaired and future ROA decreases, C, not impaired and future ROA increases. Okay, nice little question. Have to do a simple calculation, but you don't even need your calculator for this one. So again, we're looking at US GAAP, and we're testing to see whether the asset is impaired or not. Okay, so I copied and pasted again the rule here. Under US GAAP, assessing recoverability is separate from measuring the impairment loss. Now in this one, we don't have to measure the impairment loss. We just have to test whether the asset is impaired or not. So under US GAAP, an asset's carrying amount is considered not recoverable when it exceeds the undiscounted expected future cash flows. Okay, so they've given us the undiscounted future cash flows. It's cash flows of $80,000 per year over its remaining useful life, and there's 5 years of remaining useful life. So as I said, that's really easy. That's just 80,000 times 5. I don't even need my calculator, 400,000. And we can see that indeed is less than the net book value. So we have to calculate the net book value, but we should know that. That's the original cost minus accumulated depreciation. Again, I don't even need my calculator. 850,000 minus 300,000 is going to be 550,000. So my undiscounted future cash flows is less than my net book value, carrying value. So indeed, yes, the asset is impaired. So now it's not talking about calculating the impairment loss. So we didn't need that incremental borrowing rate or anything like that. That was some red herring information for you. So the second part is, so C is wrong. It is impaired. But now you have to say it's impaired and future ROA increases, or it's impaired and future ROE decreases. So, and this is a key word here. That's why you have to be very careful with your reading. It says future ROA. So we know if the asset's impaired, assets equals liabilities plus equity, A is going to go down. Okay, so return on assets is net income over total assets, and my A is going down. I think you know where this is headed. Okay. So ROA is actually going to increase because my assets are going down. And not only that, because my assets are going down, my depreciation expense is going to go down and my net income is going to go up. Okay. So you can see down here, just review the answer. The equipment is impaired. The net book value, 550,000. That's greater than the sum of the undiscounted cash flows. Future ROA will increase. Once the asset is written down, there will be lower depreciation charges, which will increase net income, and a lower carrying value of the assets, which decreases the total assets. Both those factors are going to increase any future ROA. So nice little question. One last practice question to finish this LOS. An analyst is studying the impairment of the manufacturing equipment of WLP Corp., a UK-based corporation that follows IFRS. He gathers the following information about the equipment. The fair value, £16,800,000. Cost to sell, £800,000. Value in use, £14,500,000. And the net carrying amount, £19,100,000. The amount of the impairment loss on WLP Corp's income statement related to its manufacturing equipment is closest to A, £2.3 million, B, £3.1 million, or C, £4.6 million. Okay, nice little question to end the LOS on. So remember, now we're looking at IFRS again. It's a two-step process. Number one, we have to look at the fair value less cost to sell. And we can see that's going to be £16 million, okay? And we're going to compare that versus the value in use. So they've given these numbers to us. It's fairly easy, $14,500,000. We didn't have to do any calculations, okay? And remember, we're going to choose the higher of, because to test whether an asset's impaired, this is the fair value that I can get. Fair value of £16.8 million, cash money to me minus my costs. So to check for impairment versus the carrying value, you're going to choose the higher one, not the lower one. Okay, we're not being conservative here and choosing the lower amount. This is sometimes what trips up some students. We want to choose the higher amount because we're comparing it versus the carrying value. Okay, and the loss it's going to minimize the loss. So that's 16 million, and we compare that then versus the net carrying amount. Again, I didn't even need my calculator for this one, and we can clearly see that the loss is going to be £3.1 million. So the correct answer is B. So I hope after all this, you've got a much stronger understanding with regards to impairment under both IFRS and US GAAP. And that's the last slide for this LOS. Thank you.